As of the close of trading on Friday, May 22, 2026 at 4 p.m. Eastern Time, the stock market has shut its doors for the weekend, leaving Lucid Group Inc. sitting at exactly $5.84 per share, marking a flat 0% change on the day, with an absolute standstill in intraday movement during those final regular session minutes. While a completely flat day might lead a casual onlooker to assume that things have quieted down for the luxury electric vehicle manufacturer, looking under the hood reveals a completely different reality. The expectations surrounding this luxury brand have historically been sky-high, driven by its sleek engineering and elite technical pedigree, but the modern financial landscape is forcing a harsh reevaluation. A flat trading session at these lower levels actually hides a massive tug-of-war happening behind the scenes between institutional block traders, massive options positioning, and retail investors trying to figure out if the bottom is finally in. When a stock sits tightly at a standstill like this after a period of intense volatility, it often signals a brief moment of equilibrium before the next macro catalyst forces a major breakout or breakdown. Smart capital isn't looking at the flat daily chart. They are looking at the massive volume profile and the underlying liquidity traps being set up by major institutions. The broader market expectation for Lucid has always been that its elite, industry-leading battery efficiency and raw horsepower would eventually force it into a dominant position alongside giants like Tesla stock or the premium German brands. People look at the stunning range numbers of the Air sedan and the design accolades of the new Gravity SUV and naturally assume that engineering excellence automatically translates to financial success on Wall Street. But the reality is far more brutal. The market does not reward engineering if the cash burn required to produce those vehicles threatens to dilute existing shareholders into oblivion. This massive friction between stellar product design and deeply troubling capital expenditure is exactly what is driving the current price action. Mainstream financial commentators will tell you that the electric vehicle sector is simply in a cyclical downturn, but the truth is far more structural. We are seeing a fundamental separation between companies that can self-fund their operations and those that are entirely dependent on continuous lifelines from sovereign wealth funds or massive dilutive equity offerings. While many retail traders are busy looking at basic charts on a standard individual brokerage account, institutional desks are tracking the structural flow of capital across the entire automotive sector. Look at how money is shifting away from speculative growth names and moving into highly stable, yield-generating vehicles or established automotive companies that possess robust free cash flow. If you are using a self-investing approach through standard online investing portals, it is incredibly easy to fall into the trap of buying a stock simply because it looks cheap relative to its historical all-time highs. This is where expectations deceive you. A stock that has dropped significantly can still drop significantly further if the underlying structural balance sheet does not support a rapid turnaround. Institutional investors utilizing advanced allocation models are actively hedging their electric vehicle exposure by balancing speculative positions with highly diversified index products, often holding highly resilient exchange-traded funds through major providers like Fidelity Investments, or looking at low-fee alternatives to manage their overall risk profile. When you look closely at recent stock movements, the trading volumes for Lucid have shown a fascinating divergence. During the recent earnings report, where the company posted a notable miss on both top-line revenue and bottom-line earnings per share, the initial panic selling was rapidly absorbed by heavy institutional block buying. This tells us that there is a definitive floor being established by large-scale entities who are willing to accumulate shares at these specific valuation metrics. This institutional activity is the quiet force keeping the stock stable at these lower bounds, preventing a complete capitulation. However, sector momentum is heavily weighed down by macroeconomic pressures. Higher for longer interest rates have fundamentally changed the math for luxury vehicle purchases. When financing an $80,000 vehicle becomes significantly more expensive due to macroeconomic policy, the addressable market shrinks fast. This is not just a problem for Lucid, it is a systemic pressure affecting the entire luxury consumer discretionary sector, causing massive shifts across various online trading platform ecosystems. To understand where the stock goes from here, we have to look directly at the tension between the narrative and the hard math. The common belief among optimistic retail investors is that the financial backing of Saudi Arabia's public investment fund makes Lucid completely immune to bankruptcy. While it is true that having a sovereign wealth fund as a majority shareholder provides a massive safety net that most startup manufacturers could only dream of, that backing does not come with a severe cost to everyday investors.
The reality is that these multi-billion-dollar cash infusions are often structured as convertible preferred stock or massive new equity issues, which continuously increases the shares outstanding and heavily dilutes the fractional ownership of retail buyers. If you are tracking this through a modern portfolio system like Schwab Intelligent Portfolios or using automated tools on a popular retail Robinhood app, you need to understand that a rising market cap does not always mean a rising stock price if the company is constantly printing new shares to keep the lights on. Let's pause right here because I want to hear from you on this exact structural dilemma. Comment below how many shares of Lucid stock you currently hold, or if you are completely avoiding the luxury electric vehicle space right now. I read through these comments to see how real traders are navigating these tricky setups, so definitely let me know your current positioning down there. When we strip away the recent daily price fluctuations and look at what the company actually does, the core business model relies on maintaining a pristine, ultra-luxury brand image while attempting to scale up manufacturing complexity. Founded originally as an advanced battery and powertrain supplier before transitioning into full vehicle production, their technological footprint is undeniable. They build some of the most energy-dense electric powertrains in the world, even supplying technology to iconic luxury brands like Aston Martin. Their manufacturing hub in Casa Grande, Arizona was designed specifically to scale up to hundreds of thousands of vehicles annually, but current utilization remains at a mere fraction of that total capacity. This massive underutilization of fixed assets is the primary driver of their negative operating income. When you have a massive state-of-the-art factory sitting mostly idle, the depreciation and overhead costs absolutely destroy your margins, regardless of how much you charge for the final product. Older financial reports show a consistent pattern of high expectations meeting the reality of production bottlenecks and logistics friction. In the early days of their public listing, the narrative was focused entirely on production targets that proved to be wildly unrealistic. The stock experienced massive run-ups based on pure speculation, only to face severe corrections as supply chain realities set in. Today, the focus has shifted from the Air sedan to the scaling of the Gravity SUV and their expanding partnership to supply vehicles for global autonomous fleets, including a major agreement with Uber for tens of thousands of vehicles. This shift into the robotaxi and fleet supply sector is an attempt to create a highly predictable, high-volume demand lever that can finally utilize their massive manufacturing footprint. It is a pivot away from relying solely on the fickle, high-end consumer retail market and moving towards structural, commercial contracts that provide long-term revenue visibility. Looking at the competitive landscape, the pressures are mounting from every single angle. Established premium players are aggressively electrifying their existing lineups, while dominant pure-play electric vehicle companies are using their massive scale to engage in aggressive pricing strategies. This puts a boutique manufacturer in an incredibly tight spot, forcing them to either cut prices and destroy their luxury brand equity or maintain high prices and risk low volume growth. If you are managing your capital through platforms like SoFi Invest or executing advanced option strategies via interactive brokers' trading desks, analyzing these precise margin compressions is absolutely vital. The survival of a luxury brand depends entirely on its ability to command a premium price without sacrificing its volume scaling goals, a balancing act that very few automotive startups have ever successfully executed in modern industrial history. Looking toward the future outlook, there are distinct upside and downside scenarios that investors must carefully weigh against each other. The primary catalyst for a structural bullish reversal would be a faster-than-expected production ramp of the Gravity SUV, combined with a rapid decline in capital expenditure as their overseas production facilities in Saudi Arabia come fully online. If they can achieve a meaningful reduction in their cash burn rate while demonstrating robust organic consumer demand for their new SUV model, the market will likely reward them with a significant valuation multiple expansion. Conversely, the downside risk remains tied to the constant threat of equity dilution. If global luxury demand continues to soften under intense macroeconomic pressures, the company will be forced to draw down further on its credit facilities and issue more common stock, placing a firm structural lid on any near-term price appreciation. When you analyze this stock through the lens of individual brokerage accounts, whether you are filtering for high-volume setups on an interactive brokers platform or looking at long-term holdings within a diversified Fidelity wealth management structure, the ultimate takeaway is that the market is currently pricing Lucid as a highly speculative technology bet rather than an established automotive manufacturer. The expectation was that superior technology would easily conquer the market, but the reality is that manufacturing logistics, capital preservation, and consumer financing costs are the true metrics that govern success on Wall Street. The flat close at $5.84 highlights a market that is actively waiting for definitive proof of execution before committing major capital. To wrap things up, the stark contrast between what investors hoped this company would achieve by now and the heavy financial heavy lifting still required creates a classic expectation versus reality divide. For those navigating the markets via sophisticated online investing or using automated intelligent portfolio systems, managing the position sizing on a highly diluted, asset-heavy company like this is the difference between preserving your wealth and watching it evaporate in pursuit of a narrative. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.